Sure that hear me, say g'day. They've done an update to the software that I use to go live, and I'm a little bit out of sorts. But thanks for joining us tonight. Joined behind the keyboard by Rob from Selfwealth. So thank you to Rob, and good to have him back from his. I don't know what he was doing overseas. He was doing something fun, no doubt. So any love for the Jeppy ETF, says Rag. Jeppy being the JP Morgan one. We can take a look at that tonight, Rag, if you like, because it's actually something that I'd hope people asked me about, was the Jeppy style ETFs. We can talk about that tonight. Will there be a recording to watch later, says Ola? Yes, there will be. Simon, good evening. Good evening, Simon. Happy Wednesday night to everyone in the chat. And JJ, you've said, you actually did answer my question from earlier on, JJ. You said, good evening all. My best dividend share is ANZ and the ETF is IOZ. We will talk about IOZ, and ANZ will get brought up from the shed. Says, is BTI Ballador? BTI, let's have a look at that real quick. I'm going to get that up my screen here. BTI is Ballador technology. Isn't Ballador run or operated by someone who has an All Blacks fame or something like that? Anyway, I digress. Let's get on to the most important parts of this week's Selfwealth Live, which is this week's joke. And some of you may know I was doing a humble brag, potentially. Didn't mean it to be that way, but I was talking about a Tesla that I bought recently. And this makes sense because you know what they say, with great power comes a great electricity bill. That's from Dad Says Jokes on Instagram or Twitter, wherever you get your social media. I'm sure Dad Says Jokes is there. And it's true. Although to fill up a Tesla, I got to admit, at home, off peak, is probably about $10. So it's not that bad. When it comes to using electricity for 450 Ks of range. I'm quite happy with that. We've got a LinkedIn user saying, g'day, joining us from LinkedIn. Hello to you. And good evening to everyone. So here's a very important message from the team at Selfwealth. I will let you have a look at this on the screen while I dilly-dally over here to the side. Actually, there is something I want to show you from last week. So while you just digest this very important message from the team at Selfwealth, I will now transition back to this. You can't actually see this, but this is the hoodie that I wore last week. And I forgot to tell you there was a reason that I wore it. I don't just wear hoodies to look professional. This one on it actually says, don't confuse luck with skill, especially when judging yourself. And that's from Carl Icahn, one of the great investors of our time. So 1 out of 10 for the joke, says Paul. I'll take that. I'll take that. It's pretty good. It's pretty good. So here's the part that Rob and I just really love. Each and every week, we just wake up on a Wednesday morning and said, you know what day it is, mate? And I said, yes, Rob, I do know what day it is. It's Wednesday. And he said, that means it's disclaimer day. So here it is. Selfwealth Live information warning. Selfwealth Live videos contain general financial advice only. That means the information is not taking into account your needs, goals, or objectives. So you should not act on the information until you have spoken to a licensed and trusted financial planner. My name is Owen. I'm the founder and sole director of the Rask Group Proprietary Limited. There's our company number, and we are a corporate authorized representative of number 1280930 of Wattle Partners, AFSL 383169. What that means is you can put either of those numbers into the ASX website and verify that we do have the ability to provide financial services in Australia. You can refer to our financial services guide on the Rask website. And finally, the views expressed in the live streams are solely those of myself and or our guests. We do not have any special guests with us tonight and do not necessarily reflect the views or opinions of Selfwealth. So tonight we're going to be talking about passive income, and hopefully some of you received the email, which Rob was talking about in the chat there. Passive income is probably the most important reason people invest. Some people say for growth, which is true. You know, you could probably argue that. But at the end of the day, we all want some income from our investments. And what prompted this was a few things. I think Paul might have said to talk about passive income last week or the week before. Paul, sorry to put you on the spot. But we're all starting now to receive our dividends. And particularly people who invest in ETFs, which we'll get to in a bit, or manage funds, you're probably getting something called a distribution. And you probably may or may not know exactly what that means, but it's a great feeling when you wake up and you realize that there's money in your bank account and all you've done is woken up. It's like, hey, I've got bonus points just for rocking up to today. And then in a few months, probably in about 2 months or so, many of us will start to receive dividends. The dividends from the shares from the ASX companies like your maybe not so much Commonwealth Bank, but maybe like NAB or I don't know, Wesfarmers or Woolworths, et cetera, will start to receive those in a little while. And what people do when the stock market has been very volatile is they realize how incredibly important dividends are to the return. We've said this before on the show, and it's just a rough approximation. But for every 10% that you could expect over the long term from the stock market, for example, around about 4% of that 10%, so about 40% of the return, but 4% overall, probably will come from dividends, meaning that nearly half of the return that we expect from stocks, at least historically, if we project that forward, is from dividends. So they're so important to consider as part of our investments. Okay, Chandra Khan, you've said, if you don't earn while you sleep, then you have to work for the rest of your life. That is so true. A fantastic quote right there. If you don't earn while you sleep, then you have to work for the rest of your life. So tonight we're talking about passive income. I unintentionally started my passive income journey 10 years ago when I opted into my company's share scheme because my accountant said to. Wish I did the same with ETFs back then too. Well, you and me both. Okay, so here we can see, Prem, you've said, is this live? And absolutely it is live. And right before that, Jason said, solid disclaimer. Jason, you know the drill. That's fantastic. Thank you very much. I thought I'd just spend a couple of minutes talking about how much people need to retire. Now, this is not my numbers. This is from the ASFA website. I think that's how you say it. Superannuation.asn.au. If you are so bored on your Wednesday night after Selfwealth Live, you think, I couldn't get enough of those retirement reports, you can head here. So, and here's some data from Australian Super, which I'll get to in a minute. Okay. So one of the most popular questions I get when passive income is brought up is like, how much do I need to retire? Because people think passive income takes the spot of your regular income, like your salary. And you can have both, which is a wonderful feeling, and I'll get to that in a moment. But people often then ask, well, how much do I actually need to earn a good retirement income? And so here's some numbers that have come from this website. And I think some people have said, Scott Pape, I think one of these people that have said it's probably a bit optimistic to assume these numbers. But you can see here, for a comfortable lifestyle, based on someone in this age range, it's around about 70,000 for a couple, 50,000 for a single. A lot of people get freaked out when they see that. Some people think it's not too bad. For some reason, a lot of people, when we spoke to Drew Meredith at the beginning of the year, the financial planner, he said that a lot of people aim for $80,000 even as a couple, as kind of like a comfortable retirement. And at the end of the day, how much you need for retirement is how much you need. And that's where a good financial planner comes in. So if you want to earn this level of income, how much do you actually need when you hit retirement? Now, this website also has an answer for this, and they say something along this line. So about 690,000 for a couple and 595,000 for a single. Obviously, this would vary greatly depending on whether you own your home or whether you're a renter, whether you have an expensive lifestyle or whether you don't, whether you have a mortgage and a credit card or whether you don't. So there's so much to go on here, but this just gives you a rough indication of what this website is telling us. Okay, so now that we know roughly how much people need, which is about 595,000 for a single, how much do people actually have in their super? Well, it's actually pretty shocking. You can see it on the screen here in front of you. People have, on average, nowhere near that. So you can see here that the numbers are a lot lower. And fortunately, we do have the age pension. And fortunately, people have money outside of super. So a rough rule of thumb for the industry is some people want about 2/3 of their income, 2/3 of their wealth in super and 1/3 outside of it. That's what like a financial planner might tell you. So 2/3 in super for the tax benefits when you hit retirement and 1/3 outside. But that's a general rule, all right? So a good financial planner will sit down with you and go through this. But hypothetically, we don't really need this amount of money to still feel the fantastic benefit of passive income. And I'll get to that in a minute. Don't forget, next week on Selfwealth Live, we're talking about financial independence, retire early. This is called FIRE for short. And we'll talk about how you can retire early and live your quote unquote best life. A lot of people think that if you retire early, you're kind of going to live on like ramen noodles, and lettuce leaves. It's not necessarily the truth, and we can explore that next week. But that's coming up next week. Today, we're talking about passive income for everyone, even if you don't want to retire. So, what do I mean by passive income? Really quickly, a few weeks ago, that's meant to be number 5 there. A few weeks ago, we had Queenie on the show, and Queenie talked to us about her journey to financial independence. And previous to that, I spoke with Queenie in a live show, and her and I talked about the benefits of earning passive income. So, what does it actually mean? Passive income is basically anything you don't have to actively work for. So, it's the opposite of active income, right? So, active income would be your employment, right? So, that would be like earned income. So, this should say types of income. Of the things on this list, we've obviously got capital gains, like when you sell a share or an ETF or whatever you sell. You've got interest from a bank, rental income or business income. These are all things like royalties. If you sell, for example, you're an artist, you sell music, or if you have, I don't know, an online course or something like that. Now, of all of these things, this is my absolute favorite way to earn passive income because there's really no like effort. Once you set up your portfolio in shares, it is so easy to keep that going. Now, people might say, well, rental income from a property is better because it's easier. Well, maybe, but it's also riskier, in my opinion, over the long term because there's a lot of ongoing things that you have to deal with. You have to contend with like renters or tenants. You have to have maintenance. There's a lot of costs involved, like land tax and all those ugly things that come with having such a big, bulky asset. Whereas with dividends, you can literally just have the shares and they pay income into your bank account. That's all there is to it. So we'll talk about that tonight. Another thing that people talk to me about a lot is the interest that they receive in their bank account. I remember when I started in finance, earning interest from my bank account was the thing that I thought passive income was, and that was the full stop. Like that was the end. This is passive income. The problem is if you've got income, you've got a term deposit, right? Let's have a look at this just really quickly. Say we've got a term deposit, and this is not to pick on ING, and it's 1 year, you get 5%. Fantastic. If you haven't got your money in a high interest savings account, you need to do that right now. But let's say, for example, you get 5% from your term deposit over the next year, and then the inflation rate, the price at which everything is going up, is 7%. It might be falling, but say it's 7%. You're actually going backwards. And don't forget, most people also pay tax on the 5%. So it actually works out to be about 3%. But you're going backwards. Shares, to go back to our list, shares and to an extent property are pretty much the only things that consistently over many decades have proven to beat inflation and pay income and grow. So those are like, if you want something that grows and pays income, it's typically, not always, shares and property. The other things on this list are not as easy. They require more work. So that's why we tend to focus this here. PDB, you've said, my experience with rental income for retirement income is not very positive. Just a thought. Yeah, I see that a lot. So rental income from property, says Space Monkey Mojo, goes to the bank first until the property is paid off, which takes 20 or 30 years. Definitely not worth it, in my opinion. You know what? Okay, let me just quickly, I don't want to bag out on property too much because I think it is a worthwhile investment for a lot of people. A lot of people that retire early do use property to create wealth. They take risk and they use property to create risk. Then they slowly liquidate or transition their wealth to shares because they realize now they have enough money or equity. They can use that bigger pool of assets to get more passive income from shares like dividends. So this is nothing against property. It's just there are differences which people should understand. Okay, let's go back to this. So most of us will start receiving distributions from, say, your ETF. So say if we go to Selfwealth, we'll just log in really quickly. There we go. Now say, I'll accept the risk. Sorry, Rob, I should do two-factor authentication. Please don't get angry. Okay, so CBA, let's say we look at the Commonwealth Bank of Australia shares and we can see dividends per share of $3.85. We've got the dividend yield of around about 4%, right? Fantastic yield. It's also fully franked. I'll get to that in a minute. The dividends that are paid on your shares typically in Australia will start to come in a few months. So let's just grab this really quick. So this will come in a few months, and this is called a dividend. Anything that you receive from shares are called dividends. Anything that you receive from an ETF, a managed fund, or a real estate investment trust. So a real estate investment trust is like this. It's called a distribution. They're the same thing. The only difference is how they like the naming convention, which basically represents where they come from. So these things right here in Australia are what we call trusts, and these things in Australia are called companies. Like a company would be Woolworths. A trust might be something that owns property, for example, like BWP Trust. That's why it's called a distribution. Okay. So moving on, just so you know, these things are coming up first. Like you'll start to receive these soon from your ETFs and from your managed funds. These will come up in a few months, not for every company, but for a lot of companies. Okay. I don't know why that was there. So I mentioned in the email today that one of the greatest things about for Australian investors is that the Australian share market pays a lot of dividends. So that's perfect because we want to get passive income. So the reason that Australian companies pay so generously with their dividends is because we have this thing called franking credits. You probably heard about it at the election. So basically what happens is imagine you've got the company here. The company pays a dividend because it makes a profit and it wants to send that money back to the shareholder. So this little guy or gal is you, right? However, the company has also paid tax. For example, if it earned $100 of profit, it might have to pay 30% or $30 in tax, right? And that $30, take that back. This $30 goes to the ATO. So they pay the tax and that goes to the ATO. But you over here, you're thinking, well, I own the shares. So you're saying that I'm taxed over here and I'm taxed when I receive my income? Doesn't make a lot of sense, right? At least that's what previous governments thought. So what we do is there's a credit that's stored. So the ATO, if this is the ATO down here, the Australian Tax Office, provided that you meet the eligibility required to receive franking credits, like you're an Aussie and you're a long-term investor, and by that I mean you own shares for 45 days or more, or like years, you should be eligible to receive franking credits. You can check your eligibility on the ATO website once you look at the rules. Okay, so the ATO stores this $30 on behalf of the shareholders. Now, when you do, so there's $30 there. When you do your tax return, you will record the dividends that you're receiving from the company. So say from the $70 that's left over, you receive $50 of that. So you'll put that in your tax return. But then the ATO, you're also eligible to claim the $30 of tax that's already been paid, assuming you own the entire company right here. We're just using round figures. So you've already got a tax credit stored at the ATO. And what that means is the tax that you have to pay on your share of the income is less because the company's already paid some of it. And that's a really good thing because then it incentivizes the companies to pay dividends back to their shareholders. So when you receive a notice, this is an old one from Commonwealth Bank of Australia. You'll see this in your Selfwealth account under the announcements tab. So you'll see this under news and announcements when a dividend is paid. So we can see one here for BWP Trust, this one right here. But there's an example in my notes. Get that out of the way. So you'll see it here that it says how much of the dividend had franking credits. 100% of it did. You can see the amount of the dividend. You can see the corporate tax rate. So if you go back to 30%, that was there. And so this is what we call a fully franked dividend because it's a 30% tax rate and it's covering 100% of the dividend payment. Some of them don't have that, but this is information that you can use to determine if a company is paying fully franked dividends. And that's basically all it is. Okay. So, Nakjam, you said, does that mean in other countries that do not have franking credits, there is effectively double taxation? Exactly, Nakjam. That is 100% correct. Because if you look, so say, for example, let's take Commonwealth Bank. And we can see on the overview page, we can see it's got a dividend yield of 4%, right? Roughly. Now we'll have a look at, say, one of the American banks. Now, this might backfire on me. We can see the dividend yield is 2.6%. Let's take another bank from America. By the way, they don't have franking credits over there, so 2.6%. So what we can see is that the dividends from the big banks in the USA are less than the dividends that you receive in Australia. Why? Because the Australian banks and the Australian companies know that shareholders are entitled to these franking credits. So they prioritize paying dividends. Whereas overseas, the companies know that, hold on a second, my shareholders are going to be taxed again. I'm not going to do that, which is why you see all of the American companies doing share buybacks where they buy their shares back rather than paying dividends. I hope that makes sense. So financial freedom, not sure I see the connect between encouraging companies to pay dividends when the taxpayer benefits from the franking credit. So the arithmetic is kind of like this financial freedom. So in this instance, where are we? Here. In this instance, I'll just give myself a different color really quickly. Let's give the Selfwealth green. I think that's that one. So in this instance, if there is the board of directors, this is the board of directors. Hello. They know the rules with franking credits. They are aware, right? So they'll say to themselves, what is the best way that the shareholders of my company, the shareholders who own my company, what is the best way to reward them for being shareholders? So they could reinvest the money, so they could just take the money and reinvest it back into the company. They could pay it back as a dividend, or they could buy back their shares. So this is where the board of directors sits down and they say, well, if we paid a dividend in America, we're going to be taxed and our shareholders are going to be taxed. So what we can do is we'll pay our own tax, but then to avoid our shareholders being taxed, we'll just buy back some shares. And then if you think about buying back shares, the effect is that it reduces the number of shares available because they're destroyed, which increases the profits for everyone else. And Space Monkey Mojo, how did the term franking credits come about? And as Plant One said, it was Frank who introduced it. No, actually, I have no idea. I can't remember off the top of my head, unfortunately. Zaki, you've said if your marginal tax rate is higher than 30%, the benefit of franking credits is eroded, right? Okay, I'll just be real quick and then we'll move on to some companies. But let's say, for example, this guy's name here is Tim or Timmy. And Timmy's tax rate is 45%, right? Now, if Timmy pays tax at 45%, the company's already paid tax at 30%. So assuming that we just use some very simple maths, the tax, by the time he pays his tax, less the franking credits, he's left with, in effect, like paying tax of around about 15% out of his own pocket. So he won't get a refund for this, but he'll only have to pay 15% tax on top, right? He still has to pay. So say if he received a dividend for $100, the company has theoretically already stored 30, right? So just think about that. Now on his tax rate, 45%, I don't know, for example, would be say $45, right? Now in his tax return, normally he would be on the hook for this full 45%. But because the company's already put away $30 for him, now out of his own pocket, he only has to pay $15. So the full tax rate is always paid. It's just a matter of who pays it. In this instance, the company's paid 30% of it, and he now has to pay 15% of his own tax rate, and that's it. So, so it's rough for people with high income earners, Zaki. Well, Zaki, actually, I want you to imagine for a moment, Zaki, that in this instance, instead of receiving a dividend, Tim received rental income. Right? Tim receives rental income. There are no franking credits. So in this instance, Tim would have to fork out the $45 himself. So in effect, franking credits are actually an amazing thing for high income earners. just like they're an amazing thing for low-income earners because the franking credits can be refunded, which is why retirees love them. Okay, so I couldn't think of just 5 things to bring to you tonight, so I thought I'd just bring you a whole plateful, and then we can expand on it as we go on. What I actually did in anticipation for this session, I've lost my notes, classic. Let me bring up my Selfwealth Google sheet. There it is, this one. What I actually did in anticipation for tonight is I actually scraped the entire ASX for companies that are over $1 billion in total size. And then I looked at, of those companies, how many have like a positive dividend yield over 3%. This is just based on what they've paid in the last 12 months. So remember dividend yield, guys. Dividend yield is just like saying if a company pays 50 cents in dividends per year and it has a share price of $10, then the dividend yield would be 5%, right? So 50 cents divided by 10, that's dividend yield, right? And that's typically calculated based on the last 12 months. So the previous year. It doesn't tell you what's happening in the future. So a lot of people, when they look at a chart like this, they will look at, for example, they will just look, let's highlight this spreadsheet. And sorry for the people that aren't finance people that are like, what's up with this spreadsheet? Okay, so let's just go like this. Okay, so if we find the biggest dividend yield here, a lot of people will log into their Selfwealth account or whatever brokerage account they're using, and they'll go, oh, whoopee, look at this. I'll just go and buy this stock. It says not that one. This one, I don't even know what that one is. So they'll be like, oh, wow, look at this company, Yancoal Australia. It pays a huge dividend yield, 25%. I'll just buy that, make 25% passive income. That's a bad idea. I mean, maybe not specifically for this one, but generally as a rule, that's a really bad idea because what you end up doing is you end up in something what we call a yield trap. Because remember, this uses last year's dividend payments. So it looks at what did the company pay last year in dividends, and there's no guarantee that the dividends will be paid this year. So you have to be careful not just to go in and go, oh, big dividends, like good for me, I'll just buy those ones. Remember, we're investing in the future, not the past. So be very careful about this logic. A lot of people do this, and it's pretty dangerous. You've actually got to understand, is the dividend like sustainable? Can the company keep paying that dividend into the future? So, for example, imagine if you have a company, right? Just really quickly, it pays a 50-cent dividend this year, and the share price is $10. We know from the maths that that's a 5% dividend yield. 5% return sounds pretty good, right? But imagine that same company now in the year ahead says, oh, no, we paid too much in dividends last year. We're going to cut it to 20 cents. Well, now all of a sudden, you who bought the shares at $10 a share, you're now sitting on a dividend yield effectively of 2%. Not nearly as good, right? But here's the thing. When the company announces that its dividend is going to be cut, typically the share price will fall. So it might fall in this instance to $5. So in this instance, you've lost 50% of your shares in value and you're getting a lower dividend. So you're a double whammy loser, I'm sorry to say. But fortunately, all of us here tonight are going to avoid that. And so what I've also done is I've made a list of the dividend stocks, like based on this data that I've got. It might not be 100% accurate. Then I've also combined that with companies that are growing fast. Because obviously, if a company is growing fast and it pays a good dividend, it's kind of a pretty good sign, right? And if you're new to finance, don't worry about this last column. But what this tells you is how profitable the company is. Bigger number equals better. So if you get kind of like all three of these things, you're kind of like starting to study the companies and doing pretty well. But you can see some of these companies here, like many of them you probably never heard of. You've probably heard of Woodside, which is the big oil and gas giant. You've probably heard of Fortescue, which is the iron ore company. Many of you that are new to investing would have heard of, well, everyone that's new to, everyone that's a regular on Selfwealth Live will know Washington H. Soul Pattinson. I'll talk about that, or TPG Telecom. Lavisa, we've talked about a bit. Remember, Gaurav was on the show. Domino's Pizza, Macquarie Group, which is the big bank. ARB makes the bull bars that go on most people's cars. Bank of Queensland. Collins Foods owns KFC in Australia. BHP, probably heard of that. And anyway, you get the idea, right? There's JB Hi-Fi in there as well. Car sales. Wes Farmers owns Bunnings, etc., etc. Okay. So, Michael, you said good choices, Owen. Thank you, Michael. Appreciate that. Where's this a consistent dividend? Okay. So, Kadir, you've said the coal stocks have eye-watering trailing dividend yields. Yes, they do. Kadir says, is that what you meant by trailing dividend yields? Sorry, I'm just going to check. So I meant trailing dividend yields. Okay. So, Paul, you've said, if the banks are paying 5%, is 3% from the stock market a good benchmark? This is a good question. So remember before, right, how I showed you that ING, and I'm sure many of the other banks pay term deposits of similar rates. ING pays a 5% term deposit, right? So you could lock in that return. Now, if you're a retiree, a locked-in return does sound pretty good, even if inflation is high. I mean, 5%, pretty good. 2 years, 4.9%, pretty good, right? And the important thing to remember is when you use a term deposit that's from a regulated bank in Australia, it's also got the government guarantee up to 250 grand. So what that means is if you have 100 grand sitting there and you do not want to take any risk whatsoever, the Australian government says, we'll just put it in the bank because we'll guarantee the bank for up to $250,000. Now, to Paul's question, if you took that $100,000 and you put it in the stock market and this random company right here, let's say you invested in it right at the top thinking, well, great dividend stock, and then it falls. This is just an example. Well, you've lost a lot of your 100 grand, right? So for some people, dividend stocks doesn't make sense. So a good benchmark is if you are a really conservative person, maybe shares aren't for you. But what you do give up over the long term, and many people say this, is that the biggest risk of all financially is never investing. And thank the heavens, the financial heavens, that we have superannuation, because that means that the people that are too scared to invest are forced to invest. And people at the super funds do it for them. And that's what brings them wealth. But for a lot of people, they're too scared. So sticking your money in a bank account might be right. Now, okay, so I've got a lot of questions here, so I'll try and move through. Paul, you've said Soul Patch is too expensive. Penny, if they continue to increase EG, then yes, Soul. So from a Fin Review article years back, it said, those on a high marginal tax rate, there's a slightly better outcome if they generate returns via capital gains due to the 50% capital gains tax discount, says Chop. Well, Chop, you can make money obviously two ways. You can earn income or you can get growth, or both. That's what makes shares so brilliant. But I think one of the things to keep in mind is that no matter what kind of high income, low income earner you are, the clear benefit is being a long-term investor in the share market, not a trader. Because if you trade stocks, if you try and pick which stocks to buy this month and then sell them next week and blah, 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 that's beyond me, that stuff, you're going to pay tax. If you're going to pay tax every time you buy or sell for a profit, right? And if you don't hold the shares, so if we go look at this, franking credits eligibility. So now there's a thing here, right? Where is it? Here. So there's a rule, right, from the ATO, in our tax law, that says if you do not hold the investment for at least 45 days, even if you receive a dividend with a franking credit, you're not eligible. You don't get it. So if you go back to this, now let's say, those people that try and buy CBA shares like the day before they pay a dividend and all that, and then the shares drop. One of the problems with that is that you don't get the franking credits. Because if you just buy it today and sell it tomorrow, you don't get the franking credits. But also, if you make a profit, you're going to pay tax on the capital gain. So in my opinion, my very strong opinion, everything is set up to reward long-term investors, for people who want to create wealth over the long term. So that means much less selling and all that sort of stuff. Okay, so now I've done enough of that. Let's get through the actual stocks and ETFs, the fun bit of the night. Okay. So if I just let's bring up a different color. Let's go yellow. Yellow looks fun. Okay. So I've kind of like bunched things together for you. And many of you that come every week, every Wednesday night at 6 p.m. to Selfwealth YouTube channel, you know that we talk about this stuff a lot. But for the core of a portfolio, what I suggest and what I recommend to everyone that follows us, recommends a strong word, let's say what I ask people to consider, given that this is strictly general financial information only, is that you typically have a core and a satellite portfolio. So a core might be like, say, you've got the Earth in the middle, then you've got the moons going around the outside. And in the middle, you have boring, low cost, good investments, right? Proven investments. But around the outside, like here, here, and here, you can have smaller amounts of investments that are a bit more like fun money, right? These are things, maybe not so much fun money, it's a bit trivial, but these are the investments that you make that aren't maybe like you're just taking a bit more risk with. And maybe it's instead of a 20-year or 10-year time horizon with these guys, maybe it's a 5 year, so a bit shorter term. And notice how I'm saying years. There's not many people in finance that say 10 years is like medium term, but I would consider that to be the medium horizon. Many of my peers in finance will say long term is a couple of months because that's what they're incentivized to sell you. I'm telling you, long term in the stock market is 10 years and beyond. But these are the types of things that I would consider in the core of my portfolio for the long term. And I'll explain why in just a minute. There are some trusts. So trusts are like the thing that I mentioned before, like this thing. Remember this one, guys? BWP, many of you know it. This is the thing that owns a lot of the Bunnings Warehouse properties. So not the business, the Bunnings Warehouse, but the properties that they sit on. They're all bundled up. Not all of them, but a lot of them are bundled up in this trust. So you can actually buy into the trust when Bunnings pays its rent. It goes to this trust and then it gets distributed to its shareholders or unit holders. Okay. So, I can see some questions in here. I just don't want to get thrown too quick. Okay. So Akadai saying, my view is that ETFs are okay. Says Kadir, yeah, for sure. My best dividend paying stock, says Peter, is not CBA, but CSL. CSL pays me the highest dividend of all my stocks. Peter, congratulations. That's incredible. CSL is a wonderful dividend stock, assuming you bought it quite a while ago. Because I'd imagine this is the case for you, Peter. CSL is a wonderful company. And what CSL has done, I'll show you quickly. So CSL, which is it's one of Australia's biggest companies. It does like, probably the thing it's most well known for is like the snake bites. It does the anti-venom if you ever get bitten by a snake. Well, let's say you're around at Sally's place having a barbecue and a tiger snake comes out and you get bitten. Well, you'd go down to the hospital, they give you an anti-venom. That's probably come from CSL. Another thing is that they do the influenza stuff. So a lot of the things like the manufacturing of that this comes from CSL. Anyway, this company doesn't have a very high dividend yield. Why? Because its shares have grown so quickly and it's such a highly valued company that the dividend yield is quite small. So people buy this for growth and for dividend income. Okay, back to my thing here. So some of these things some of these things are different to ETFs. So these are all ETFs, some trusts or REITs, companies here. And here are some stocks, right? And notice how I've said diversified. This is the owner of Bunnings Warehouse. This is one of the big banks, the number 5 big banks. And this is a company that I talk about all the time. They used to own Priceline Pharmacies, Washington H. Soul Pattinson. They own many different businesses. Like they own some coal stocks. They own a big part of TPG Telecom. They own so many other things that they own. Many brands you would probably know they own, just like Wesfarmers owns Bunnings Warehouse, Officeworks, and a few other things I'm forgetting. So I've got a question for everyone here. I'll actually break these down in just a minute. But when I look at my favorite dividend stocks and different investments overall, what do you think they all have in common? Some of you who have been here for many weeks or even a couple of years on Selfwealth Live will know. What do you think they have in common? So, Michael, you've said I'm very much into diversified stocks, but considering entering into a few ETFs. We'll get to that in a minute. Will the recording, be available? Says Pawan. Yes, it will be. It's always available. It is available on the Selfwealth YouTube channel. So yes, absolutely. So you can actually catch up on all the previous episodes on the Selfwealth YouTube channel. Selfwealth YouTube, right here. Some of our most popular episodes of all time are actually our passive income sessions that we do. So the Tesla one last week didn't get much love. Bit upset about that, to be honest, but that's okay. So anyone want to say why or what you think these things have in common? And this isn't like Wheel of Fortune or The Chaser. You're not going to lose anything if you get it wrong, but if you can guess, maybe you get like a bit of digital praise from me. And I'm about 5 seconds ahead of you guys, so I'll give you maybe another 30 seconds, and then we'll go from there. So, all right, 5, 4, 3, 2, 1. Let's move on. So, Space Monkey, they're diversified. Good management. They all have growing dividends. Cash flow, says One Sydney. They pay dividends. They pay dividends. O'Brien. Yes, they do indeed. Okay, so I'm going to tell you what they have, and they're huge, owner managed, huge market cap, solid history. All of those things. Everyone is correct, basically. All of those things are correct. So now, notice how I think Michael said it before. I'm going to get rid of this yellow. Actually, it's not really doing it for me tonight. I'm going to go blue. So diversified, and I said ASX 200, and these things people will know are pretty well diversified. These things are diversified. This thing is diversified, and this thing is diversified. The only one that's not is Macquarie, but we'll get to that. Okay, so this here should say portfolio risk, right? So when you have a passive income portfolio, a lot of people just go in, like I said before, and they pick the one stock or the two stocks with a high dividend, and they go, well, if I've got $100,000, well, let's say $10,000, maybe that's more a realistic investment for a first timer. When I say realistic, it might be the portfolio size. And let's say you've got a 5% dividend yield. So you pick one of these companies with a 5% dividend yield, and you go, bada bing, bada boom. If I just hold on to that stock for a year and it pays its dividend, I'll get $500 in the mail. I'll wake up one day, just like Owen said, I'll roll over, I'll check my phone, and I'll say, oh, look at that, $500 in my bank account. Well, yeah, maybe you do. But like we said before, maybe the dividend gets cut and you get $200, which is not as good. Okay, so what we say in finance is that there's a risk spectrum that people should have. So I'll draw a line for you in just a second, right? Just like this. Okay, so imagine that this line is the risk of your portfolio, maximum risk. So this is maximum risk. I'm very scared. This is the number of positions or shares that you own. Now, notice how this blue line never goes to zero. At this level, there would be no risk. That doesn't exist. Like if you invest in the stock market, there's always going to be some element of risk, no matter how good you are. Even Warren Buffett loses money occasionally, right? So in the stock market, we say that there's this kind of invisible line just down here, and it looks something like that. Geez, that's remarkably straight. And we call this the risk that you cannot diversify. This is, and has this for a name, undiversifiable risk, meaning you can't get out of it. So we call it a market risk, right? And this applies, have a guess what? If you invest in the stock market, there's always some risk. So we call it market risk. Let's say, for example, no matter how good of an investor you are, your portfolio still falls 10% in the next year, and then it goes up. Well, there's still some risk in that, right? So now, notice how this blue line, however, does decline. In the past, stockbrokers, remember those stockbrokers are not really that popular anymore, but in the past, stockbrokers used to say, if you just buy 30 stocks, you're pretty well diversified. Just buy 30 stocks, right? I heard someone once say to me that this is a race to 30. Once you're at the starting line, you got to get to 30 stocks, Owen. Get there and you're diversified. I thought to myself, that doesn't make a lot of sense. What if they're all crap stocks? They'll all go down at the same time and I'll lose all my money. But the principle is the same. If you have 30 stocks, right, and one of them goes down, you've still got 29 left, right? There's still going to be some risk that applies to all of them, hence this part down below. But it's better than having all your money in one stock, right? So that's the principle here. Now, there's another line that they say here, which I won't bore you with too much, but this is only for the major stock nerds like me. They say that if you have around 10 different stocks or 10 different things, you'll remove most of the risk of the portfolio. So from like here down to there, that amount of risk. So basically more stocks equals lower risk. But there's a point where you can't, adding extra won't make a difference. And that's really evident. So anyway, let's move on. So why do I like these things? Because all of these things, we'll go back to blue. I quite like the blue. All of these things don't do one thing. So inside of this ETF, which we'll talk about, I talked about it in the email today, VAS, you've got 300 shares. In this one, and I can't remember who said this at the very top of the show tonight, you've got the ETF was the IOZ ETF, IOZ, boom. That's got 200 shares inside of it. Beta shares, the A200 has 200. State Street has 200. That's the STW, the first ETF in Australia. Okay, so what I mean by this is specifically inside of all of these ETFs, and remember an ETF is just a basket. Let's see if I've got some ETF content here. ETF. And I do not have any ETF graphics. Oh, that's sad. Anyway, okay. So in this instance, it would be like this. Not you, you, and you. So if you buy into an ETF, right? So say, actually, we'll do a hypothetical. If you buy one stock, you're up here. It could be a great stock, by the way, and you never experience any risk. Like something profound could happen. You could be like the person who picks the one out of the 2,400 stocks that just goes up and up and up and up and up. Right? You could be that person, but chances are you probably won't be. Like chances are sooner or later, every stock will fall at least a little bit. So if you have a one stock portfolio, you're starting at this point right here. In other words, very close to this thing called maximum risk, right? Now, maximum risk can also mean maximum reward, right? Because some people might pick the one stock that goes up forever, which could be, you could be like buying the next Amazon or whatever, but it's very hard to do. With an ETF, you effectively get a basket. Look at me just quickly draw this basket. Oh no. So this is a basket. And inside that basket, you get all different types of flowers. So here's an analogy. You get all different types of flowers. Let's say you got some roses, you got some lilies, you got some whatever is in there. I don't really have that much in my vocabulary, but let's say there's a lot of different flowers. You don't have to worry that, you picked the wrong flower. You've just got them all in one basket. So you just buy the basket, and the basket is called ETF. Inside of the A200 ETF, which is this one, inside of the iShares ETF, the IOZ ETF, which is this one, you got 200. VAS ETF is 300, and this one from State Street, STW, has 200. So you're automatically, just by making one investment, you're pretty well diversified, right? So you could come in. This is just an example. When I say you, I mean like everyone could come in. This is what makes ETFs so special. You can make one investment and you get exposure to all of these different investments, right? So instead of buying just Commonwealth Bank of Australia, you get the whole basket, right? Now, there's another way you can do this. You don't have to just take everything that's on the stock market. Like you don't have to get all 200. You can choose a specialized ETF. So there was one that I wanted to show you, which I haven't talked about on the show before, but I get a lot of questions about, which is called the MVB ETF. So in the cheeky title for tonight's show, Robin and I said, forget CBA, here's 5 dividend stocks instead, or something like that. And if you own CBA, you're probably like, wonder what these guys are up to. But anyway, inside of this ETF, so this is the Van Eck Australian Banks ETF, and you can find it with the ticker symbol MVB, just like this bad boy right here. You just knock that in. And inside of this basket, you've got 20% of it. I'll zoom in a bit. You've got 20% of it in NAB. You got 19.88% in CommBank, 19.6% or 5% in Westpac. ANZ, remember that was brought up. 19.2% in ANZ. You got a bit of Macquarie, you got a bit of Bendigo Bank, and you got a bit of Bank of Queensland. Very small parts of the portfolio. But you could, instead of buying one bank, you could just buy all of them with this one investment. There's only 7, but all of them. So in this instance, the MVB might be somewhere like here. So it's still higher risk than the one that's got all of the different shares, but at least there's a bit of diversification rather than just saying, I'm going to buy CBA. Now, CBA, I think CBA is probably the best big bank. So I would happily own CBA shares, but I'm just saying there's an alternative if you're looking at ETFs. Now, again, I say this a lot, but people hear me say this type of thing. Oh, so Owen, you're saying you can go and buy one of these ETFs and you're down here automatically. Great. Or you say you can buy this one. Great. One ETF doesn't do everything in a portfolio. I just want to be clear about that. Like one ETF doesn't do everything. You know, we say that so just take this yellow thing. So say here, this might be, where's my text gone? Here we go. So this ETF might be for Australian shares. So I'll just go AUS. This ETF over here might be for USA, right? Now this little bit here might be cash. That's really small, isn't it? And this little bit here might be for bonds. We've talked about them in recent weeks, and that is, gee whiz, Owen, that's not good. Bonds, like James Bond, bonds. And down here, you might have, I don't know, gold. Geez, is that a gold? Yeah, that's gold. And that would be close to a diversified portfolio. Now, you could have ETFs or stocks or whatever that do all of those different things, but that just gives you an idea of how to build passive income. So what do I think is reasonable from a diversified portfolio like this in income? Probably around about 3 or 4%. From the shed, you said buying a bank ETF is not super diversified. That's correct, but from the shed, that's why it's up here. So it definitely wouldn't be super diversified. Remember, this portfolio risk chart that I have here is only showing you the risk of investing in shares. You should always have a more diversified portfolio that includes things that aren't shares. In the previous weeks, we talked about bonds. And in the previous weeks, we talked about how to use your cash wisely. We've talked about gold investments. We've talked about investing in things that aren't on the stock market. So you want to look at all different types of things, not just ETFs, not just these shares, not just all these different stuff. Kumar, you've asked a very good question here, which I don't really have that much time to answer because it's such a brilliant question. But you've asked, are US bonds going to go up now with US markets starting to recover, hopefully? That's a very good question, Kumar. Very good question. Maybe that's one for another day. So financial freedom, you've asked a question here. But in short, Kumar, I kind of believe that it's really interesting now for those investors. HVST, financial freedom. Let's have a quick look at this ETF. HVST, dividend harvester, right? Love what the guys at Beta Shares do. Don't really love this ETF. I get a lot of questions about it. Please, no thanks. I get a lot of questions about this ETF. When you compare the returns of an ETF, it's really important. I want to be very clear with you guys. It's really important that you compare the total returns, right? So this ETF, reasonable ETF, not saying it's terrible, but it's really important when you look at it that you look at the total return. So let me just explain what that means. I'll get my favorite little Mr. Squiggle up for those of you that can remember Mr. Squiggle. Don't know where he is now. Hopefully he's okay. So when you have a total return, what I mean by that, so the total return that you get from an investment is the income, right? Plus the growth. Sounds pretty reasonable. So let's say you buy in your portfolio, you buy a dividend stock and you get $5 in dividends, just using round figures, and you get $7 in growth in the shares. You got $12, right? $12. We'll put 12 here. So you got $12. Pretty straightforward, right? Most people, when they come to investing, I'm using a lot of counterpoints tonight, but you get the idea. A lot of people, when they come to investing, they only focus on this or on this. Notice how I said or. So a lot of people just focus on the income or the growth. But I say, like the young Mexican girl in that tortilla ad, the taco ad, why not have both? Why not have the hard and the soft shells? You can have both. But what it means is You can't go for the thing that has the biggest income because then you'll go down in growth. And you can't go for the thing that has the biggest growth because you might give up some income. So you want to balance between the two, even if you're seeking income. And I'll give you an example. Here. So this ETF, right? So this ETF, the Harvester ETF, what it does, some people will know this is a particular type of ETF that targets dividends, but in a very specialized way. I won't go into it, but it targets ETFs in a very specialized way. Now I want you to compare that return. I'm going to do this on the fly. I don't know the answer to this question. Full disclosure, I may be getting it wrong. But let's take it, the most vanilla, boring ETF that is available. It's the biggest ETF in Australia. Everyone knows it. It's the Vanguard VAS ETF. Let's have a look at this ETF. Okay, give me, not charts, please give me table. Now, you could buy this ETF, right, that says, oh, I target dividends. Look at me. Great, good for high income, right? So you're thinking, so far, so good. It says it goes for dividends. All right. And it does it in a kind of magical way. So you get the returns from it over the last year, net of fees is 12%. Or you could just get the boring one. This is not net of fees, but you can see the total return here. Oh, I think it is net of fees, actually. Yeah, it looks like it's net of fees. Okay. So this one here is 14%. This one does nothing special. It just goes and buys the 200 or 300 shares. That's all it does. And it's returned 14%. So sometimes you look at ETFs and you've got to compare the total return. This one might pay you more in your pocket. So what do I mean by this? Imagine, for example, I'm sitting here and I've got my pocket here. You can't see it. It's just out of shot. But say, for example, I take $10 out of this pocket and I put it back in that pocket. Now, it's a whole robbing Peter to pay Paul type situation. You've got to be careful because some ETFs do that. They take it from the growth and they just put it in the income and they make you think, oh, in this pocket, I'm getting lots of income, but the growth is disappearing. So it's really important when you look at an investment, you take both into account. And so that's why I was very, very careful about which shares I put on the screen tonight because, yeah, right here. So here, I've chosen, some people said they were big companies, they were established companies, and they are. Like I would happily own some of these shares in my portfolio. They wouldn't be all of my portfolio, but I would happily own some of them. But I didn't, you notice how I didn't choose a company that's involved in mining in outback Africa, a really risky company, because I wanted you to understand that these big companies, the boring companies, are often the best ones because they're the most stable. Because you don't really want it to be the case that when you buy an investment that it kind of falls in, it stops paying dividends or it's a pretty fragile company. You kind of want something that's rock solid, right? Even if it's not as sexy, you kind of want it because, yeah, I know it's pretty boring. Yeah, I own Woolworths shares. Like you're not going to rock up to your next cocktail party and be like, hey, guess what, guys? Just bought another few grand of Woolworths. Great, huh? But then the friend that's over there has just bought a speculative maybe some Bitcoin or something like that. That's a lot more sexy than the story about Woolworths. But Woolworths will pay more income, I bet, over the long term. Okay, so now I want to just give you one more thing. We've talked a lot about like the nitty gritty of investing, but you can just chuck all of these on your watch list and you can start to research. Please go back in time and look at some of the previous Selfwealth lives we've done where we talked about the different types of investments you make. If you do like the passive income, please go back to the beginning of the year where we talked about all the different types of passive income you can get from the stock market and from building a portfolio. We spoke to financial advisor Drew Meredith, and I think Jamie might have joined us for one of these. Yes, Jamie joined us for one of these shows. Fantastic, most popular of all time, just there on the Selfwealth YouTube channel. But I want to show you something magical. I want to end with something magical. And I want to show you what's possible when you buy an investment and it turns into a passive income stock. I'm going to cherry pick. Okay, guys, I know this. I'm going to cherry pick and I'm going to show you a company that I've owned for many years. So full disclosure, I still own this company. I've owned it for many, many years. Now this company, right, its current share price is $65. Now, I'm going to select, how long do I have? 10 years. So if we go back 10 years, this company's share price was 45 cents. You can probably see it. Maybe you can't really see it because my screen's in the way. Let me just, not that. Let me go like this. Can I put myself over on the side? There we go. This is the one that I want. Sorry, guys. So 10 years ago, this company's share price was 45 cents. You can see it right down the bottom corner. It's now $65. So meaning that it's gone up a lot. I don't even know what that number is, but it would be an insane amount, right? It's a lot of money. It's a lot of money to go up that far, right? From 45 cents to $65. Imagine every dollar you have goes up 120 times. It's a lot of money. But not only has the share price gone up, I'll get rid of that. It's also paid dividends each and every year that have got bigger and bigger and bigger and bigger, to the point now where the dividends every year are 22 cents. So in this instance, right, imagine you bought it all the way back here for 45 cents. Imagine you put $10,000 down. Right? You thought, this is a small company, but I'm going to take the risk on it. It's a little bit risky. I know that. I've got a diversified portfolio, right? Now, for every $10,000 you'd invested all the way back then, it's now paying you, what's that? The equivalent of nearly $5,000 a year in dividends. Plus, you'll get franking credits. So you're probably going to get about an extra $2,000 in franking credits, meaning the original investment pays half of itself off each and every year from here on, as long as it pays a dividend. So in this instance, not only has your investment return gone up 120 times, it's also paying you a ginormous dividend. Within 2 years, it will pay itself back in full, just in the income that you receive. And so this is the beautiful thing about the stock market. This is obviously an outlier. This is an exceptional company, and I've been very lucky to own it. But it's not the only one like this. And remember, if you own an ETF, like let's say you own VAS. We'll go just pull it up in Google, actually. So the VAS ETF, you're still receiving your modest dividend each and every year, but the shares from this time in the GFC, of course, from this time a long time ago. So this is in 2009, it was 50. Now it's 91. So it's gone up, not as much, but it's gone up consistently, and it's paid big dividends that entire time, which you could have cashed in and then reinvested back in again. That is the beauty of the stock market to generate passive income, because you can invest in something that pays income and it grows. That is what makes the share market beautiful. And thanks to things like ETFs, you can start building a portfolio with probably like 3 or 4 or 5 ETFs. You can cover off most of these things pretty quickly. You don't need like a degree. You don't need all that stuff to start earning passive income. And trust me, if you do start going down this path, and then in a year from now, we do the same show on July 19, 2024, and you've already received your first dividends, you'll begin to realize how powerful it can be. It starts really slow, but then it builds up like a snowball again and again and again. Alrighty, bit of a plug for some upcoming shows. In August, we'll be joined by the mighty BetaShares. BetaShares being one of Australia's biggest ETF providers. They'll be joining us in August, and we'll be going back to the drawing board with 4 experts from BetaShares to talk about how to build an ETF portfolio from scratch. I can't say much more than this other than what I'm about to say. There will also be giveaways involved. I can't say anything extra other than what hopefully Rob will talk about in time, but there may be, wink, wink, giveaways coming up. So keep that in mind. Finally, my quote for this evening comes off of a photograph of my jumper. I wasn't joking when I said it has a quote on it. Does this make it tax deductible? Because I've used it now. Don't confuse luck with skill, especially when judging yourself. So don't confuse luck with skill, especially when judging yourself. You may need to listen back to this session a couple times to get a sense of what I'm saying. But remember to go slow, speak to your financial advisor if you're confused about anything that I've said, and maybe just rock up to Selfwealth Lives if you want to keep learning. And that's about it. So I will spend a couple of minutes now just answering some last minute questions. Forgot to scroll down. CP said, in the stock market, the rearview mirror is clearer than the windshield. Absolutely, it is. Like, imagine thinking that Pro Medicus CP would go from 45 cents to $65 in 10 years. Incredible. It's actually the best performing stock on the entire stock market over the past 10 years. I think that's still accurate. So I'm pretty happy with that. Stephen, you've said I was lucky to get Pro Medicus cheap too. That's great. Troy, you've got a good question here. You've said, when creating a satellite and core portfolio, what do you look at? Say I want to do a 70-30 portfolio. Is it the number of shares, the current market value, or the total cost of shares that I use to determine the split? I'll tell you how to answer that question. So I can only give you general insights here. Obviously, Troy, I can't say exactly how to do it. That's what a financial advisor is for. But hypothetically, let's say the way we think about, you said 70-30. We've talked about this a lot on the show, but what that basically means is that 70% like this in risky assets. We call them risky assets because they go up and down a lot. So risky, and 30% in what we call like defensive. Let's go, just like this. My grade 4 English teacher might be happy with this. Look at that cursive. Not really. So 70% in risky stuff and 30% in defensive stuff. Right, that's a pretty normal Australian portfolio for someone that's not in retirement. Once you get to retirement, you start to balance it out a bit more. But this is also called growth, right? And this is also called conservative, or whatever you want to call it, income. Some people call this income, but sometimes income isn't defensive. So this is what when we say 70-30, this is what we mean. Now, a core and a satellite portfolio applies to all of this, I think, right? So when you have a core or satellite portfolio, what this basically means, not quite that amount, Owen, is it's like this. So you've got the 30 here and you've got the 70 here. Now within this, you still have like many different investments. So it's not just like one big 70% investment. And within this, you also have many different investments. And that's where a financial advisor would break it up, right? So it's not just like one big one. Now, to be honest, most financial advisors that I come across these days are now building portfolios where this part of the whole portfolio actually probably only has, say to be generous, 5 to 15 different investments. Some people some financial advisors create portfolios with less number of, and they mainly use ETFs, right? This is not stocks. They use ETFs. They use listed investment companies, which I didn't really talk about tonight. They'll use managed funds. So that would be like Magellan Fund, if you know what that is, or things offered like from Fidelity or insert name. They would use stuff like this. So these things by themselves are very diversified. And then they'll say to their clients, hey, Sally, Jennifer, if you want to go and have fun, like go and put some money in individual stocks and you can put them around the outside, or you can try and build your own portfolio, but just don't mess around too much with this one, right? This one here, just kind of keep that diversified, keep it balanced. And by the way, 70-30 is what the financial advisor sits down with you and goes over. Like, I don't know anyone listening circumstances, so I don't know what's appropriate, but that's what they go through. But that's how you answer that question. Okay, so financial freedom, not easy to write with a mouse. Yeah, I know it's not, is it? Apple needs to come up with something where I can just like draw on the iMac. Okay, so we've got some other Owen Quinn. I love this one. 80-20 until the day I die. I'm going to make a bumper sticker saying that. Owen, if you make a bumper sticker saying that, I will buy one of those bumper stickers. 80-20 until the day I die. Please go for it. Okay, so a couple more questions is real quick. Another great one, says Danica. Thank you, Danica. Are defensive stocks only bonds and cash? So Verghese, that you've asked this question. So defensive, when we say defensive, we don't mean stocks. We mean things like bonds. I think Rob put a link in the chat to that. And when we say defensive, we mean things like cash, And there's a few other things that can go into that bucket. We've done a separate session on that if you go back through the videos. And then on the other side, the growth side, that's where we put stocks and shares and all that. Chris, we've said core from passive episodes. VHY, VAS, IVV. Yeah, a lot of good ones there, considering overlap. Good one. We did a session on picking ETFs. And remember, August is about that. Okay, so I can see so many of you got some wonderful comments. We'll be back next week. Don't forget, I've kind of gone over time. Sorry about that. But next week, we're talking about retirement early. So if you're thinking about passive income, well, if you're thinking of retiring early or even on time, what's the thing that you need when you give up your job? Exactly, passive income. So today's session is going to lay the groundwork for how to retire early and the type of portfolio you might need when you retire early. So next week, we'll be talking about all those other bits of the portfolio and how it all kind of comes together, not just for income, but for growth as well, and how you kind of build that portfolio to begin with to retire early, and then how you maintain it throughout retirement. Hope that makes sense. So thank you, guys. That's it from Rob and I tonight. I think we've gone through a lot, and it's been great. You may need to watch it back once or twice. Thank you, everyone. Thank you so much. If you do have any questions for the Selfwealth team, you can direct them to selfwealth.com.au, and you're in the bottom corner, there's a thing that says support, instant support, something like that. I don't know what it is. Sorry, Rob. I don't know exactly what it is, but the Selfwealth team will sort you out over there. I'm Owen from Rask. Thank you for joining me. Back next week, 6 p.m. Wednesday night. Great session tonight, everyone. So thank you, team. And if I know how to turn this off, I will say good night and bye for now.